It's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything real estate, mortgage, and interest rate. So let's dive into those interest rates. It's beginning of August 2021. We are, again, approaching our absolute all-time low. We are 2.77 on the average 30-year fixed, according to Freddie Mac. We are down 3 basis points. We were at 2.80. Now we're down to 2.77. You can see that blue line is we caught, and that's at the bottom of that screen there. We caught around the 2.65 in January. We got all the way up into the kind of low threes, and now we're back down again. So we are 100% in that trend of rates staying low. I made a video last week. I'll link it right here above where I talked about where rates are going to go for the rest of the year. But let's get into the meat and potatoes of this kind of conversation. We're going to talk about what, I know this is kind of funny. Don't just stay with me, okay? But what a college course has to do with mortgages. And really what I mean by that is pass fail. Have you ever had a class that was pass fail? Have you ever had a test or some sort of, pass fail scenario? That is a lot of what kind of mortgage environment is like these days. We are so highly regulated that we need to treat everybody the same. So we used to be able to, and I use we as kind of lending industry, use more logical underwriting. Oh my gosh, they're worth millions of dollars. We'll be able to get a loan. Now it is ability to repay. Do they have the ability to repay the mortgage? Is it a pass fail? And I've talked about this concept before, debt to income. And I'll put a video link up here, is the amount of debt versus the amount of income. And that's one of the key calculations that we use. Now, in mortgage lending, it's pass fail. So let's assume you need to be under 43% of the amount of debt versus the amount of gross income. At 42.99, you pass. At 43.01, it's a fail, right? Now, there's plenty of other programs, and there's a way to go about it, and you've got to apply to be able to see if you're credit qualified. And then we're going to, look at every application based on a lot more than just that. But with that said, there's so many different parameters that are more pass-fail oriented than kind of logic-based, right? If you have $1 more than what we need to show for the transaction, meaning your cash to close, your down payment, your closing costs, the amount you may be putting into escrow, something like that. If you need $50,000 and you have $50,001, then it's a pass. If you need reserves, if you've got your $50,000 plus some reserves and you've got $1 more than whatever it is that we are calculating, it's a pass. And that really is how underwriting looks at it. So get that preconceived notion out of your mind that I've got to save so I have all this extra money. You have $1 more than what you need, it's a pass, right? So you check that box, you move on to the next one. Do I carry this much of debt, right? Do I have this much income? Is my credit score at least this? Now, obviously, the better the credit score gets, potentially the better terms would be. But with that said, if you meet that threshold, right, if you get higher, it's still a pass. So think about it like this. If you're going into a transaction, if you're going into thinking about you're going to buy in the future, think about a pass fail in a high school class, in a test that maybe you took for continuing education. If you have licenses, things like that. If you went to college, you have college classes that were pass fail. A lot of the lending industry, to make sure that we're treating everyone equal, is pass fail. So put that in your head when you're thinking about it next. So this is Ryan Skaggs. This is the Mortgage Minute. Thank you so much for tuning in. Check out the other videos, and we'll be forever, ever grateful for subscribe. Get that like button if you enjoy the content, and we'll see each other again very, very soon.